Hey everybody, it's Kenny Schaaf, and I'm here today to talk to you a little bit about our 2022 forecast, economic forecast, and want to share some of that information with you. So let's go ahead and get started with that. So basically, what we're going to look at here, hang on, let me get into my screen. Sorry about that. Basically, what we're looking at, we're going to start with the 2022 forecast where we left off in the 2021. All right. So we're going to 2021, the interest rate, we expected rates to rise at the beginning of the year and recover into the fall time. Actually, what happened? Rates did rise sharply through March as we anticipated, but recovered a bit earlier than we expected, gaining back most of their losses by late summer. Housing. We all know the housing market, there's strong demand and very tight supply. And this would help push our home prices up by single or a high single digit percentage. Actually, in some places, it went up by over 19% in some places. That strong demand and tight supply um, really hit us, but COVID caused supply chain disruption, labor shortages, and it pushed the real estate values even higher than what were forecasted. So, what's going to happen in 2022? The Fed will play a major role in the 2022. The Feds are beginning to taper. They're going to do some rate hikes. They're going to have a balance sheet runoff. All of these things can impact market equity, drive interest rates, impact housing, as well as jobs. Um, Fed voting members, I don't know if you're familiar with it or not, but there are 19 Fed members. 12 of them are voting members, and four of them rotate out each year. The Fed members that rotated in this year may lean more towards the tightening the rates. So the 2022 compositions may be less accommodative than the 2021 Fed rates. And in fighting the inflation has to be the main focus. Inflation is at the highest level it has been in 40 years. It's rising that sharply. Uh, Fighting the inflation has to be the main focus, and negative stock market reaction could cause the Fed to not raise those rates to try to keep everything tamed. The Fed should have hiked rates sooner. They mistakenly thought the inflation was transitory. History can help us forecast how the Fed's actions in 2022 will influence the markets. So let's do a quick little history lesson here. In 1970s, this was Arthur Burns. He was the Fed chair. He ignored inflation, which was rising rapidly. He used the word transitory. Sounds very familiar, right? We're hearing that today, or we were. Year over year, inflation ballooned from 7% in 1978 to 14% by the time he left in 1980. He insisted that the inflation was transient. That higher inflation rate caused mortgage rates to rise from 12% to 18%. I mean, 18%, that is nuts, right? Why do bonds affect negatively to the inflation? Inflation erodes your fixed return that you get. You're buying things with a fixed budget, and as costs rise rapidly, it's making that value of that fixed return less and less over time. So the only way that they can combat that is to charge higher rates on the newer future loans. Right. In 1980, this was the Fed chair that took over, Paul Volcker. He fought the inflation. He hiked the federal funds rate from 11% to 20% in 2 years. He went up 9% on the Fed's fund rate in 2 years. And today we hear grief over a quarter percent. Just put that in perspective from the past. However, the inflation when he did this dropped from 14% to below 5%. And because that inflation dropped, mortgage rates sharply declined from 18% towards the 12% range. But there were consequences to this. The S&P 500 declined by 30% during this time, and tighter monetary policies pushed the US into recession in 1982. So this name you might be a little more familiar with. It's Alan Greenspan. He was a Fed chair in the late 1990s. Under his watch, inflation doubled from 1.75% to 3.5%. The inflation caused the mortgage rate to go from 7 to 8.5%. But unlike Burns, Greenspan took action mid 1999 and hiked the funds rate by 1.75%, which matched what the inflation was doing at that time, from 4.75% to 6.5% in a year. When he did that, inflation responded and dropped from 3.5% towards 1%, and the mortgage rates dropped from 8.5% to 5.5%, which sparked a huge refi boom at that time. But again, consequences. The S&P fell by more than 50% from spring to fall of 2000. And 2001, the US entered another recession. So let's think about that for just a moment. Looking back, you're going to see twice they were fighting inflation. Twice the stock market didn't like it. Twice the US entered a recession. So today enter Jerome Powell. The inflation has increased under his watch from 1.75% to 7%. He thought it was transitory also. Higher inflation caused the mortgage rates to rise from 2.5% to 3.375%. What the Fed is currently tapering their purchase of mortgage bonds and treasuries, they won't do a rate hike while they're doing that. They won't do that at the same time. Right now, it looks like the Feds will be done tapering in March, and we're looking at the first rate hikes coming maybe in May. The Feds are targeting three rate hikes in 2022 and 2 or 3 more in 2023. If the Feds can tame the inflation, interest rates can still rise until the Fed acts. If the Feds can tame inflation, mortgage rates should drop. But until that happens, they still could continue to rise. Inflation should rise through February, so we'll make it hard on the MBS market, especially with the tapering. So let's recap this for a minute. If you look at all of these, you're going to see where they all change. 7% to 14% inflation. S&P down 30% in a recession. 1.75 to 3.5. S&P down 50%, recession. Stock market, or Jerome Powell, 1.75% to 7%. The inflation response, it should drop when the Feds begin to do the rate hikes. So the mortgage rate response should decline as inflation declines. Stocks are expensive and the economy is slowing. So are we entering another recession? It's something we have to watch. It's very possible. But there's a lot of wild cards that will factor into this. Some of the wild cards, this first one, is you probably would have already thought, is COVID. COVID could play a major influencer on monetary policy and supply chains. If we do have any type of major surprise in COVID, it could change the outlook dramatically. One of the things we're looking at is if it's anything beyond what the Omicron is. Omicron, we're already here, it's already out, highly infectious, but the dangerous of it seems to be much lower than the prior strands. So pending we don't have any additional strands that come out crazy, that shouldn't affect us too much. Now, if the government decides they want to send more stimulus out, giving more money away, this could fan the flames of inflation. It would temporarily push stock prices higher, and it could cause the mortgage rates to rise further, and it could make the Fed's attempt to corralling that inflation much more difficult. And we talked about the runoff of the Fed's balance sheet. The way they do that is the first step, Feds to stop purchasing new mortgage bonds and treasury, probably somewhere around March. Again, hiking the Fed's fund rate somewhere around May. So right now, the Feds are still buying $70 billion a month in mortgage bonds through reinvestments, and that's what's keeping that interest rate lower. If and when they stop these reinvestments, mortgage rates could move higher than previously thought. So what is the stock market going to do? Now, if you look at all indications right now, stocks are the most expensive and are very expensive, and the price to earning multiples are high. If you look at a lot of this, everything for the most part, is extremely overvalued. With rate hikes, it could cause the price Sheeler, price to earnings to contract, resulting in lower stock prices as we've seen in the past. So what does that mean? Forecast looking probably at roughly a 10% decline in the major stocks in 2022. Interest rate forecast, we anticipate mortgage rates to rise along with the inflation during the first part of the year towards a 3.75%. Right now, if you've seen the rates this week and seen what the markets have done, we're pushing that pretty quickly. This week, we've seen a pretty dramatic increase in the interest rates over the past few days. Uh, with the Fed action, a softer stock market, and slowing economic conditions, interest rates towards the end of 2022 should head back down towards the 3% or a little bit lower. So what we're going to definitely suggest right now is don't be out and buying a lot of points. Any of my clients, I'm not going to suggest buying points just because of this. Don't look for the lowest rate right now. Look for the lowest cost, because there's going to be a huge opportunity for your clients and our clients, or you, the consumer, to refinance it towards the end of 2022, which could save you significantly. So again, right now, not suggesting that you're going to buy a lot of points or do a lot of that right now. Just get into the lowest cost mortgage as you can. Even if the rate might be a little bit higher, it's not going to make up the difference of what you can save once we do that refinance when the rates go back down. Housing forecast. Housing's going to remain strong. Don't know if it's going to stay as strong as 2021, but the demand will be slightly softer due to the higher interest rates. But any means, it's still going to be a robust market. Supply will increase, but it's going to remain tight. Why is it going to remain tight? Tight labor, supply chain disruptions, semiconductor shortages will all play a role. You wonder why semiconductor? Everything runs on them, from your refrigerators to your thermostat. They have to have those to get in there. Rents, they're going to continue to rise. Increases will remain above 5% over last year, pushing many people to see the benefit in buying. So the forecast mid to high single digit appreciation on your homes, it's still going to provide a great wealth creation opportunity. And just let me go back to the rents for just a second. Rent is up roughly $360 a month from where it was last year at this time. So if you were to take that $360 a month and put that towards what you could have purchased with a home, you would see an additional $70,000 in your purchase price. So as you can see, the forecast looks good for wealth creation. Interest rates are going to, push higher the first part of the year, go down towards the latter half. I'm Kenny Schaaf, and if you have any questions on how this can affect you or what you should do on your mortgage, or if you're a realtor and you have some clients that are interested, share this with them so they can see the forecast and we can go from there. Again, I'm Kenny Schaaf with Guaranteed Rate. Feel free to call and reach out to me with any questions you have, and I'll talk to you soon. Bye for now.